Welcome, friends. On this episode in my weekly call with Colette, we have a special guest that is going to talk to us about the fraction appreciation mortgage. This vehicle might help you unlock the equity in your home so you can start investing in real estate. Join us. I am Araceli, a wealth advisor, real estate investor in the United States and Canada, and creator of Wealthy Women in Real Estate. Every week, I meet with Colette, a real estate broker and a real estate investor in Canada. We come together to talk about all things real estate investing and how to increase your wealth. Join us. Okay, welcome everyone. This is Araceli, a transition wealth advisor and a real estate investor in the US and Canada. And I'm here with my partner, the star of the show, Colette Rava. Can you introduce yourself?
Of course. Hi, you're so cute. I'm not the star. We are all stars in my
Yes.
mom thinks I'm a star. That's pretty much it.
There you go.
That's all that
She's the
matters.
only one that thinks I'm a star.
It's good enough.
But thank you very much. My name is Colette Raba. As you know, I am a real estate broker in the GTA. I like to work West End, anywhere from Etobicoke all the way to Burlington, and if I have really good clients, maybe beyond that. But let's keep it at that for now. I am so excited to talk to my friend Dawn Lumsden, who is a mortgage broker with the company Pineapple. And of course, every time I see her, I want to have a pineapple type drink.
Yeah,
Not a margarita, but
it sounds refreshing.
I like the margarita.
yeah.
I'm not adverse to that.
But anyway, welcome, Dawn.
Thank you so much. Thank you,
We're
ladies,
glad
for
you're
having me.
here.
And today we actually have a very special subject, right? And it's
Yes,
fraction appreciation mortgage. I never heard this before, and I'm looking forward to find out what that is, Dawn, for
it's
sure.
it is so exciting. It is new to the Canadian landscape of the mortgage industry. It's a company that has brought this to Canada. Who they've been doing it in the U.S. for many years, so it's uh, very successful in the American landscape of mortgages and of borrowing money. And so they're the first to market in Canada. And a lot of people say, oh, it's like a reverse mortgage. And yes, it has similarities as a reverse mortgage, but it's actually more beneficial to more people. It brings out to everybody, not just a select 55 plus as a reverse mortgage does. So it's quite interesting on how it works.
Oh, interesting. Now, you do have a presentation today, right?
I do. Would I be able
So
to share my
tell us,
screen?
because this is also going into a podcast, so we want to just kind of
For sure.
tell people what it's in the slide, and just explain to us a little bit more about what this
Yeah.
fraction
So I'm going to
appreciation
share my
mortgage
screen,
is.
and I'm just going to, just talk to what I kind of have on the screen. I'm not somebody who likes to read per se, but I do have some notes in front of me to make sure I answer those, those burning questions that everybody always has. So let me share my screen. Let me know when you can see it, ladies.
Yeah, I can see it now.
Great, Colette, you
So,
can see it. We're good.
got
All
it.
right. I want to make sure the star of the show is happy here. You know.
Well, and the other thing too for the viewers, like if you're watching this live, it will be recorded at where you can pause or you can take a shot, a screenshot of the slide. You can always call us or email us if you have any other questions about it, or if you want to reach Dawn directly. I'm sure her information is all there for you as well.
Yeah, absolutely, absolutely. So
Yes.
again, what I want to talk about with you ladies today is called the appreciation mortgage from Fraction Technologies. And again, they're the only lender in the Canadian landscape right now that is offering this product. So they're very client centric. I will say I've been very impressed with the clients that I've taken to them, that they've been able to service and help our clients in a fast turnaround time, which has been great. So let me just get started here and scroll down. It's one of the fairest ways to access the equity in your home, they say. What this company does is, I'll start it with a quick comparison of a reverse mortgage to appreciation mortgage.
Sure.
A reverse mortgage, they'll lend you up to 55% of the equity of your property based on your age, and the minimum age requirement is 55. Now, I will say at 55, I've yet to see anybody access the full amount of that 55%. The way it typically works is the older you are, the more money they'll give you, the more equity they'll give you from your property, up to 55%. So if you're just starting, that retirement stage at 55 and you want to be in that product, chances are you're not going to be able to utilize as much equity as you're hoping to. With this product here, which the advantage is that it is straight up to a maximum of 50%, and there's no age requirements. It is strictly built on a couple fundamentals. You need to have a credit score of at least 680.
Okay, hold on a second. I'm writing all this down because I need.
So the credit score, this is also one of the things that we really emphasize to everyone when they're looking at their finances, that the credit score is very important, even though you're not, let's say that you're not going to be ready to buy or do anything for a few years, that you should be looking at it at least once a year. And this is where you're going to be able to use it, right, Dawn?
It's so important. And one of the big things I do as a mortgage agent in particular is I start out by educating around credit. How does your credit score? How does your credit bureau? What does it tells a story of who you are as a borrower. And that is one thing that, all lenders look at. They want to make sure.
Sorry. So I just want to go back to say credit score is a minimum 680.
680. Yes.
Okay, great. Okay. So I'm writing all this down so I'm clear. And then up to.
And what they'll do is 50% of the value of your property.
Okay, so which means to know, let's say I bought my house 10 years ago, I have to go to who? The bank, or do I say to you, I need to get an appraisal because now I don't know how much my house is worth?
So let me walk you through this process because it's actually a really great, easy, seamless process.
Perfect.
If you listen to your mortgage agent, if you follow your mortgage agent's advice.
Okay.
So one of the beauties of this is having a credit score of at least 680. We do not qualify you based on income, but they do like to see that you do have income coming in. We want to make sure that you have a way to support yourself, And then the biggest thing is they look at your property, and as per the value, they're going to give you up to 50%. 50% is the maximum.
But I can't say my house is worth $6 million. They won't believe me.
Well, that's up to exactly. So during the
conversation,
we have honest conversation. And okay, what's your house worth? What do you think your house is worth? I then rely on sometimes a realtor to come to me and I'll say, hey, can you give me some comparables in the area just so I have a good scope? Colette,
for you,
my girl. So when I think about that, I think about, having real conversation, honest conversation with our clients. And, I always love that meme where it shows what you think your house looks like, what the realtor thinks your house, the bank, and then
what the city thinks your house is worth, right?
And it's quite funny because it's quite true, right? We all think this.
Yeah, of course.
So we put in what we think is a fair, equitable amount that your value is.
Okay.
Now, through the journey of the approval, we actually validate that by having an appraisal and an inspection done on the property.
Okay.
So those are two things that are a requirement to being finalized for your mortgage.
So
with them is an appraisal and a home inspection.
Okay.
Okay. So the biggest beauty of this, and this is why I love this product, is you can utilize 50% of the equity of your home with no payments. I said that right. No monthly payments for 5 years on an open term, meaning that in year 3, if you decide, hey, I want to do something different, I'm going to sell this property and do something different, there's no penalty to pay out.
Well, let's say, I'll give you an example. So the example would be somebody like me that I get paid commission. So if I have a $10,000 commission check and I want to take $5,000 of that commission check and pay it down, I'm allowed to do that.
No.
Oh.
This product is us as Canadians need to start opening our mind at how lending looks.
Yes.
And what the landscape looks like. And one of the things about this product is that during that we're going to call it a 5-year. We're going to stay in a 5-year open term. That's the only product they offer. During the landscape of that 5-year open term, there are no mortgage payments and there are no payments at all that can be made. You either carry on or you pay out everything at once.
Oh, I see. So I can't just put money
You
into
can't
it
make
as
what we
I
call a
go if I
prepayment.
feel
So,
Right.
so what happens, Dawn, after the 5 years?
Okay, so at the 5-year mark, bank's going to call up you as a client and say, hi, client, here's where we're at. We're at the end of your 5-year term. We need to run an appraisal on your property. And so the bank, on the bank's dime, pays for this appraisal because they need to know what the value of your property is and how much the appreciation has gone up. And that's going to be something we're going to talk about as well. They go in and do an appraisal on your property, and they then say, you know, we'll use a very simple math example because it's the easiest example that I can collate it to.
sure.
Today, your home is worth $1 million, and you want to utilize 50% of the equity. So you're going to utilize 500,000.
If you own it outright.
Yeah,
you
if
have
it's fully
Yeah,
paid.
so we're using 500. However, that 500 has to be paid out from a current mortgage or whatever that looks like.
Okay,
They
but
will,
we talked about this earlier. So just to be clear, if my mortgage on my $1 million house is 500,000,
this
that
product,
it's not for you.
this product will work for you if you don't want to make monthly payments.
Right. If in 5 years I'm going to win the lottery and I don't want to make any monthly payments, then I can take that 50% that of that is equal to $500,000,
Right.
take the money from your lender, pay out my mortgage, and for
Right.
5 years I don't pay anything.
That's right.
And now we're at the end of the term, which is at the 5-year mark.
Right.
What do I do? And that's
Okay.
what we're
Right. So I'm going to give you the first analogy here because this is a really important one. This is the basic, simple understanding.
Is that one of your slides?
It is not on one of my slides.
Okay.
I talked to this. I can show you something similar, but this is a very simple analogy.
Yeah.
Okay. Simple analogy is your property is worth $1 million today, and you're able to utilize 500,000 of that, whether it be in paying out a current mortgage, paying out some debts, whatever that looks like. You have access to 500,000. Fraction mortgage will always be first place on the charge of your mortgage, meaning that they can't be second. You can't hold a mortgage with Scotiabank for 500 and think you can come get another 500. It is straight up only 50% of the equity of your property. Okay. Now, that 500,000 at the end of the, so again, your property is worth $1 million, you have 500,000 as a mortgage. The end of the 5-year term, the bank comes and says, we're going to do an appraisal now, and we're going to check out what the value of your property is. So let's just say that the property's gone to 1.2 million. It's gone up 20% in value over the course of 5 years, which is very fair, very reasonable, very realistic in our landscape of what's happening with our world today in real estate.
Yeah. Yeah.
Now what happens is, and this is something that I want to talk deeper about. They now issue you an interest rate at the end of the term, not at the beginning, not like how we've been used to lending here in Canada, whereas we need to know our rate, we need to know our monthly payment. I got to pay it off fast. How can I have my payments? Yeah. That is all out the window here in this new lending. This is like, let's open our minds and really expand what we can do with the equity of our property. So at the end of the term, your property is worth 1.2 million, 20% increase. Great, congratulations, you got 20% equity. They take that 20% and they divide it by 5, which is the term of the mortgage, giving you a 4% interest rate.
Okay.
So now they take that 4% and they add it on to the money that you borrowed, the 500,000, and they do their calculation just like any other lender of how interest is accumulated through the term of a mortgage. And they just add it on. Okay. Now you say, well, I really like what I'm doing. I don't need any more money. I like to stay status quo. Great. We're just going to give you a renewal. Instead of your mortgage being 500,000, your equity, what you owe is 500,000. We're just going to tack on this interest that accumulated over the course of 5 years now, and that's your new mortgage amount.
And then you have to pay that off. You get another 5 years?
You can take it for another 5 years.
Oh, okay.
So,
yeah, that's what I was going to ask you. You do it every 5 years.
Every 5 years.
And you don't have to pay anything from the first 5 years to the second 5 years. That gap in between.
No.
Oh my gosh, that's crazy.
So before I full out say no, I will double check that there's no fees associated, like with renewal
Of course.
fees, that they don't have a
Yeah, that's
renewal
what I'm
fee.
asking.
But
Yeah.
typically, they're not saying, okay, you're going to have to give us $100,000 and then you can roll it. It's basically the bulk of that money and the interest are all rolled into
It just continues on, right?
Continues renewals.
Okay, so and the interesting thing that, you know, when we talk about that after that, so let's just say I've accumulated in my bank account X number of dollars now at the end of the 5-year term. If I choose to not continue and roll it back in, I can go to Dawn and say, hey, Dawn, I want to get out of this. My term is up now. Let's find another mortgage with a different whatever lender, a bank or whoever, and then I will start paying a monthly fee to whatever my mortgage now is currently 500,000 plus the 4% or whatever the percentage is going to be at the end of the term. And then you calculate, okay, now you owe X number of dollars. Yeah, that's great.
Yeah, I'm going to show you the standard growth. Yes.
So the other thing too that I just want to make clear with the viewers is that there is a cap to that amount of interest.
Yes, and that's what I'm going to speak to too.
Yeah, and so people don't have to be like, oh my gosh, well, what if it goes up?
Yeah,
right.
We're going to pay 20%. Oh, wow.
Exactly. So I'm going to talk about two scenarios, a standard growth and then a slump growth, a market slump. As you see in my slides, I just flip back and forth.
Boo, slump growth, boo.
Boo, yeah, exactly. I don't believe in the slump, but here we are. So
you have to be realistic.
One of the ways that fraction works is that they have what's called a floor rate that they will charge, meaning a base rate. If nothing happens, everything stays status quo, in 5 years' time, your home's still worth $1 million, you pay 3.49%. Okay.
Very good.
Let's say your property goes up 40%, 50%. You know, again, and Colette, you can attest to this. It's very realistic. You know what's happening in our industry, in our market today.
Yeah, there's no shortage right now.
There's no, so it is a possibility. The highest interest rate that they will ever charge is 7.99%.
So they cap it at 7.
They cap it at 7. Yeah. So we have a floor and we have a ceiling.
So you can call Araceli and say, hey, could you do the numbers for me, the maximum I have to pay and the minimum I have to pay, and whatever is going to happen in between.
Right.
The only number we really don't know is what my value is going to be after that 5-year term.
The appreciation value.
You have no control over that. That's really what the market will bear. Right?
And here's here's a couple things that I say when people go, oh, 7.99%, like they're very shocked by that. The truth of the matter is that's private lending rates.
That's a great private lending rate.
Right.
Right now, if somebody wants to go to a private lender, you're looking at 12-15%.
Oh, absolutely.
Yes. And so at 7.99, I say, look at the bigger picture. You've had money for 5 years that you have been able to use as another stream of income, potentially investments, buying a rental property, buying that cottage you've always wanted, having another piece of property, or having investments.
Yeah.
Okay. So you've used the money for
improvements.
Exactly. There's so many things.
Sell it. Right. And if you want to sell it in the 5 years from now,
exactly,
that's possible. With the improvements that you've made, your value will go up too.
Exactly. And so you've had that money for 5 years. The value of your home has gone up over 40%. Let's think of the bigger picture. The property that you're mortgaging has gone up at least 40% if you're sitting at a 7.99% interest rate.
Right.
You have other happy problems, I'll call them, to be thinking about, not worrying about a 7.99% interest rate.
No, it seems very, very reasonable. I like the fact that they cap it, because obviously then let's say it could be more. Sometimes, we've seen here in the GTA 30% appreciation in 1 year. So, if you continue to say, oh, I'm going to take half of that, then that'll be tremendously high.
Exactly. So when you think about what you've been able to do with the money, of how you've invested it, how you've made that money grow in the 5 years that you've just been given to make no repayments on, and now you're being potentially given a 7.99% interest rate. What have you made on the return of your initial investment? I bet you it's going to be a lot higher than the 7.99%.
Right. Yeah.
right? And
Okay.
it goes, that's very powerful. But it's, again, having us open our minds to a different way of lending. It's
Yeah.
very, when
Yeah.
people go, I don't know what my interest rate is. I'm like, no,
Right.
but
Well,
you have a scope. There's a
right.
range here
And
where we know you're going to fall in there.
I think it makes sense to say this right now as well, that we are just giving you this as a presentation. We are not telling you this will work for you or that we're recommending it. This is just our way of giving the information out there. Uh,
Education.
yeah, it's education. Please do your research, talk to whoever you need to talk to, get your independent advice, just like we tell everyone. Anything you do, this is a legal document with a lender. Get your information out, make sure you talk to your lawyers and
Yeah,
other people that your financial advisor, to see if this is a right product for you. So
Yeah,
this is just a
absolutely.
new way of doing things, like Don has said. And Pineapple is the only company currently that is doing something like this. Something like this is so incredibly good for people who own their house outright. They want to buy an income property and they start, they're buying an income property. That property is going to raise in value. Your current property is going to raise in value. There is a way to do this in a different, thinking, okay, well, instead of taking a HELOC out and then having to pay it back immediately, this is just an alternative to that as well. So,
exactly.
so these are the
Exactly.
things, yeah.
Yeah.
So,
So one of the things that I just want to add here is that remember, everybody's different. Of course, your credit score will be different. That will determine how they're going to lend you the money. But the most important thing is that you need to consider the long-term implications of why you want to do this. Every time it's just about the planning. What are you planning to do with the money? What if something goes wrong? What if? So just have a couple of scenarios that you know that this money is well spent.
That's why it's so important to go to an expert. And so you're absolutely right. And part of what I do as a mortgage agent, it's not just about saying, oh, fill out the application and I'll get you this. No,
yes,
I want to know what your journey is. I want to know what your end goal is. I mean, I always hated the question, when we were all, going through the companies of, where do you see yourself in 5 years?
right.
You know,
Yeah,
The
where
other
do
thing
it's just
too,
not about taking the money. Oh yeah, I
yeah.
got money. Yeah, right.
But this is what I talk to clients about. Like, what is your end game here? What do you hope to accomplish? Is this just something short term for 2 years? You want to renovate and get out and buy a property way up north? Are you
Don,
looking to buy investment properties?
sorry, do you want to go and continue with your slides? Do you want to bring up?
Absolutely.
Okay.
Absolutely.
The other
So
thing,
you went over the
yeah,
standard, the standard market. So what happens if the market doesn't really appreciate as much as
Absolutely. So, these are some of the advantages to fraction, just as my slide shows. Just, people I'm sure can be reading it as we've been talking, but it's tax free as well. Whereas if you go, and need money and start doing investments and taking the money from your investments, it's a tax implication.
Mhm.
Here,
right.
take money from your home, there's no tax
The
implication.
other the other thing too is what you really have to, when you want to start this process with Dawn, you have to consider things like if you need to get out early and if there is any penalty. You
Right.
also, if you have a mortgage currently with a bank, let's say, you have to see how much your penalty is with
Right.
that. So these are all the nitty
And
gritty little things that you have to
exactly.
go through with your mortgage broker, Dawn, before you say yes or no to these things. So it's not like, okay, tomorrow I can get this done.
It's not a one and done, and it's not a cookie cutter product. It's a
Exactly.
great product that helps a lot of people because, as we know, our buying market has become very strong investor buying versus
Yes.
home ownership, right?
Correct.
Like first time home buyers. So this is a great product for investors that
Right.
are looking to utilize, money, keep rolling it over into more rental properties, more investment properties.
Absolutely. And
You
we
know,
want to present all our investors or investors or actually people that want to become investors to have options because now we have less and less options to get into the market. So this seems like a great product. So
I
exactly,
just thought of
exactly.
somebody else who could use this product. The
And that
Bank of
is,
Mom and Dad. The Bank of Mom and
yes,
Dad. So if your children want to buy a condo or something, you want to help them out and not pay anything for 5 years. this might be the product for you too. So it's just
Exactly.
another option for you.
Mhm.
Right. And it's so true. It has opened up to so many more other than the 55 plus world. This is, the young, energetic and eager that are doing investment buying. And I love them because they're just so full of energy and they're sponges. And I do love that of teaching them of things,
Yes.
And it's also about the families that, want to buy a second home, like a cottage, but don't necessarily have what we show on paper, we'll call it,
Right.
the ability to do so.
Well, just to give you another, thing that happened to me, excuse me, is I bought a secondary property with a HELOC. So that's a home equity line of credit. So this is somewhat like a home equity line of credit, but I don't have to pay back
Yeah.
like I am doing a home equity line of credit. It rolls in with my mortgage and I have to pay a larger amount per month. If that doesn't work for somebody like, let's say me, if I have, I'm on a commission based sales, I don't know what my monthly payment is going to be. That's not going to work out for me. But if I can say, okay, I'm going to defer it for 5 years and then I can use that as an income property and make that income and build the equity and put that money into savings. And then at the end of
Investment.
the 5 year, I have a lump
Yes.
sum that I can pay towards that secondary property plus, whatever I need to pay out
It,
after the 5 years.
exactly. And how I've looked at it as bigger picture again is expanding our minds, is that understanding that this becomes a double stream income potentially for you.
Absolutely. Yeah.
You've utilized the equity out of your property. You're not making payments. So if you have the mindset, oh my gosh, I have a $2,000 mortgage payment, take that $2,000 and invest it.
That is
Start
actually
investing.
one of the things that why a lot of investors don't want to take the equity out of their home, because their cash flow, it becomes affected. So that means they're paying more money in order to take that equity. So
That's
this
right.
could be a really good product. So, it's worth looking
Exactly.
into it.
Well, and it creates more streams of income for families, meaning
Yes.
that, you're not making a monthly payment. You potentially are buying another investment property to use as rental income. So now you've just taken the money and put it into investments from your mortgage payment, and you've taken the lump sum and you've bought a new property.
Right.
It's about thinking bigger picture of how we become wealthy on our own, and we utilize the equity of our home.
We love that. Okay,
Yeah,
We
so
love
let's
that.
move to the
interesting.
other side.
So let's talk about a market slump. Let's, not that I'm not the bearer of doom and gloom. I don't buy into doom and gloom when we watch media and they say, oh, the rates are going up, or the market's going to crash.
We all
I've
hear
been
that.
doing this for 20
Yeah,
plus
but
years.
you do have
And
to discuss it, right? Because
we
it
have to be
is,
realistic.
it's a
Exactly. We have to be
possibility.
realistic, but I will not buy into the doom and gloom and start, the campaigns of get in now because the rates are going up tomorrow. I don't believe in that. I believe in finding the right product for our client.
Right.
The rate comes second. We all have competitive rates. We're all in the same pool. If you were, looking for a rate 2 years ago to today, obviously the rates are gone up. However, it's all relative. So I'm very much of the non doom and gloomer. But we do need to be real and talk about, if in the event that a rate slumps or the market slumps, excuse me. So here you'll see on my slide, and forgive me, I just looked to the left of my screen because I have a double screen on my desk here. If you buy your property again at $1 million, and in 5 years' time, it's gone up less than 1%. I show you what you've taken out in year 1, and I'm going to show you what you owe in year 5. Okay. The rate of interest there is 3.49%.
So you actually don't want your property to increase.
To increase the value, yeah.
Well,
Yeah.
yes, I mean,
This case.
but it works two ways, because if you're somebody who wants to utilize equity again in that 5
Absolutely.
years,
Well, you
You
want to
want-
be protected. You want to know that you're not going to lose an incredible amount of equity.
right? So here's the beauty of this is, we can see what's happening in the grand scheme. Your property's only gone up $50,000, so it's worth $1,050,000. That 50,000 essentially has just been your interest that you've paid. So you're not any further behind. You're not, based on a market slump and the appreciation value not going up in your property, you've had money for 5 years that you essentially just, it's a
Amazing.
wash.
Right.
That's
Right.
great.
You still own your house and you still have a lot of equity there to use.
Yeah.
Okay.
Awesome.
So
Okay.
again, it's very simple looking, and we give you just high level examples here, but these are conversations more so to have with your experts, whether it be starting with the realtor, your financial, advisor, or myself, that these are conversations that we get this journey going with.
I think these are options for people. So, all of these new products are coming up now because of the need that we have, at least here in Canada and the GTA, right? So,
Yeah,
absolutely, we need to look into all of these different ways to do things.
absolutely. Absolutely it is. And again, this is where I talk about let's open our minds of leaving the Canadian mortgage lending criteria. I need to go to the big bank. I need to find out what my interest rate is, and I need to make a monthly payment. And can I afford that monthly payment? Those are three great things that have built Canada and the strength of how our industry works. And we have great protections in line for our
Yeah.
clients to ensure that we don't have crashes like the US did many years ago.
Oh, yeah, the US is
However,
completely different. It's the wild, wild
they've
west.
had, but what we've done as Canadians, as conservative as we are often in our lending criteria, and it becomes very difficult to obtain those mortgages. It's also to protect the end user, us as homeowners, and
For
making sure that
sure.
we're able to live a lifestyle. This is just an added layer. Fraction is governed by FSRA and OSFI and all the other governing bodies that govern over banks and how they lend. They haven't kind of slipped under the cracks and where they get to do whatever they want. This has all been vetted through all the government, governing bodies that lend to
Yeah,
us.
I am sure that the mortgage brokers will not be able to offer it if it was embedded. So,
Exactly. So, just so you know, Colette had said that Pineapple's only offer it. So Pineapple, as our brokerage, we offer it. But Fraction is the only company in Canada, they haven't gone Canada wide yet. That is in the works. Fraction is the only company that offers a product like this,
Okay,
other
awesome.
than a reverse like chip and mortgage.
Sure. And I'm sure that other mortgage companies will go to the company Fraction and
Yes,
ask if they can do it as
yes.
well. So
But
you're just
I'm one of their number one partners. I just want to throw it out there.
yeah, absolutely. Absolutely.
Let's
that's
my own
good.
horn right now.
It is. Like,
Okay, so what else? What's
yeah.
next?
So, we've talked about possibilities, home renovations, purchasing a property, because maybe you are, a couple that have the bank of mom and dad who've said, we're going to help you with your down payment. You got 50%. And you know what? And now you have, an opening to buy a property with 50%, and you don't have to make mortgage payments for 5 years. It really draws it really draws an open book for you.
Yeah, this is fantastic.
Investing in new opportunities, having a regular income. And like I said, I've gone in and thought about this kind of like a little bit larger. Let's create another stream of income, and that's where, Colette
We
comes
all
in.
need that. I think that
That's
everybody
fine.
is more aware more than ever that this a secondary income is what we all need.
It's what we all need. So whether it's you're taking, like I said, those monthly mortgage payments that you were to be making and start using it as a part of your investment portfolio, you buy another property and use it as a rental income and start growing that. There's so many different opportunities to utilize this money with and really create that extra stream of income. I want to talk about how they qualify you a little bit too, just so we're very clear.
Okay.
Sure.
Qualifications is, again, we talked about appraisal. They will ask you for your income, but they don't qualify you on your income.
Do you want to continue your slides because we're still on
Sure.
the same slide?
Sure. Thanks
I
for
want to
letting
see
me.
what else there is.
Oh, it's so exciting.
I know.
We talk about let's helping with your goals. That's what we were just talking of what it means about having more income streams, about be able to create, more income, more wealth for yourselves without having to work 95 hours a week, unless you want to work 95 hours a week, But it's just, so these are just little topics
It's
that
just buying
told
you
them.
time as a self-employed person to say, I this potential money is, let's say I do have no mortgage for 5 years, I can take that money and invest it in my own company too, as well.
Exactly.
And
That money,
to think
you
that
do what
five
you
years is
want.
going to grow.
Yeah,
Right.
you do what you want. And I'll give you an example. I have a client right now that I am working with. She is self-employed. And I always say it's not what you keep, it's what you show,
Absolutely.
right? And us as all self-employed ladies here, we all understand this,
Yeah.
you know. But when it comes time to borrowing from a major lender, they want to see what you keep, or they want to keep what you show.
Right.
And a lot of times what we look like on paper isn't qualified. It doesn't qualify for your needs.
Absolutely.
This kind of product here, or doing different alternative lending, it's not always about your income.
That's the thing that I hear a lot from investors. Why can't I I have this $1 million piece of equity, my house. Why can't I use that to do something? Like, why is this money sitting here? I want to use this money to do something with it. How do I do it? So this is
exactly. And one of the things as investors or as self-employed people, again, what we're showing to the government on our T1 generals and all of those documents doesn't necessarily correlate to what happens in our income stream.
Yeah, absolutely.
And I'm not saying to hide anything from the government. This is the disclaimer. I'm just saying it is what it is.
Correct.
But the point is that then when you want to go as an investor and you're saying, I want to take the equity out of my property. Let me go to big bank and show them my papers, and they're going to say, sorry,
you don't have an income.
You don't have enough of an income. That's
very,
a huge,
very important.
Huge problem. So I go back to my client who's a dental hygienist, owns her own shop, is making money, has a great form of income. COVID has kicked her in the butt, as it has many self-employed people. And now the banks are saying, well, we want 2 years average. Well, we're in 2-year COVID. We're in year 3 of COVID. People have been shut down. Their income has been impacted.
Right.
The beauty of this is we don't care.
In that next slide about the home renovation. So
yeah,
that and see what that, pandemic. So you're just talking about the pandemic. That's fantastic. Actually, that is my cottage. It's my escape.
Yeah. And these are the things, like, if anything, COVID has taught us, we need to figure ourselves out of how we're going to make money, how we're going to change our lifestyles and keep moving forward.
And who knows if this is going to continue, if there's going to be another strain, if this is going to continue. Like, please don't, absolutely don't talk about it. But you never know. And if it's not a pandemic, what else could it be?
Yeah, there's always going to be something. And this is what people don't understand. Right now, think that everything is, doom and gloom because the pandemic happened. But every so often, we have something happening, either in our lives or in the general public. So it's not about if it's going to happen. It's when it's going to happen.
When it's going to happen.
So, exactly.
And I do believe that as terrible as this COVID has been to our world and our individuals as humans, it's also given us the opportunity to get smarter about how to take care of ourselves financially.
I agree.
Absolutely.
And
know what's really important in life. And that's
exactly.
If this is going to trigger something else, because the pandemic, it could trigger, we are seeing signs of a recession. So things like that we have to prepare for things that exactly what Araceli said. It's not if it's going to happen, but when it's going to happen.
Yeah.
Okay, so what's the next slide?
So basically questions. I've kept it very light and simple because, again, it is a very simplified product. There's a simplified process. You fill out an application. I ask you for some documents. We send it off, get an approval, comes back, we get an appraisal and inspection. We send it up to your lawyer to do all the administrative work, and we fund your deal.
Very simple. Dawn, can you put the other slides so people can see your information? No, just the last one. So tell us.
I'm so pretty in this picture.
Tell the audience how they can reach you. What is the best way to reach you?
You can reach me by, I have an Instagram page. It's Dawn Lumsden at _go pineapple. I'm on Facebook as Dawn Lumsden. Give me a call. There's my details there. My email, dawnlumsden at go pineapple. Very simple.
Okay. So because for the podcast, Dawn can be reached on her phone is 647-628-0719, or you can also reach her at www.lumsdenfinancial.com, and that's spelled LUMSDEN SDEN financial.com.
Thank
So
you.
this is amazing, Dawn. Thank you so much for being here today with us. I really appreciate you sharing this new product and who it could be for. Because at first, when I saw it, I thought it was a reverse mortgage, but then you started to explain this, and this is actually fantastic for people that want to become investors that have the equity in their home. That's
Exactly.
amazing, amazing.
It really does help so many more people. It's not just for 55 plus. It really
Yeah,
goes
it
beyond.
is. Remember, it's about options, and that's what we're here for, just to show you different options as they come in the market. So,
So
Absolutely.
let me just take a second to recap. Can you close your screen so people can see our beautiful faces for the last moment? Because
There we go.
we are all
yes.
stars of the show. So just to recap, if you own your own home, you can borrow up to 50% of the equity. You have to get an inspection and an appraisal at the beginning. You have a 5-year no payment, but it's an open term, which means you can pay all of it out at any time. That's the only thing. You can't do little payments during that 5-year term. This has to be like a first mortgage on the property, so you can't have another property. And if you do
You can't have another mortgage on this property.
Another mortgage on the
right,
same property.
and if you do go to sell it, that has to be paid out first. And then also, and there are, if you decide to leave the product in between the five, like if your term hasn't come up, you probably will have penalties, but that's something Dawn will go.
No,
Even if
the
you
5-year
decide to
open
pay out,
term, no
open term.
penalties.
So if
Which
you want to
means
pay it
that,
out,
other than a discharge fee, which is a standard government fee,
discharge
there's
fee.
no
Okay.
penalties
Okay,
with
sorry.
the lender.
Discharge fee. Yes, discharge fee. And that's what all lenders will charge you
Mhm.
anyway.
Mhm.
And then the interest is calculated at the end of the term, and it's capped at 7.99%.
Yes.
What did I forget? Is that it?
No, I think that's it.
You forgot called on.
Oh, yes, of course. Well, that's a given. That's a given, of course.
Yeah, well, the one thing that I just want to say for last is remember, you have to have a plan.
Yes.
Talk to Dawn and see if, what can you get out, but what are you going to do with it? Make sure that you put it into something that is going to generate income for you,
Don't
right?
buy a Maserati. Sorry.
Exactly. Don't buy the
Don't go to the
Maserati that you
casino.
Don't do it.
Yeah, don't go traveling the world with that money, right?
Well,
So,
hey, if you think you're going to make
I'm kind of on the
money when
fence
you
about that
travel,
one.
well, it could be, yeah.
But if, let's say you want to be a blogger and you're making money as you travel, then we can't say that's not a bad, that's
Yeah,
I can't.
have the plan. The whole point is
Have a
to have
plan.
a plan.
right. And we can't tell you not to buy a Maserati. If you really want to do that, then hey, that's up to
All you.
Yeah, absolutely. Well, thank you so much, Dawn, for being
Thank
here.
you, ladies, for
I
having me. I've
really,
had a
really
great time with you
appreciate
guys.
it. And whenever you have something else new, we'll love to have you back. So
Anytime. Just even to talk just about, the basic
well,
mortgages.
if you and I want to go get a little veal sandwich or something,
yeah.
Maybe at that little restaurant around the corner is a very good place.
All right, ladies. Well, thank you so much. And we'll see you next week. Thanks, Colette.
Thank you.
Thanks,
for
Dawn.
joining us, everyone.
Talk soon. Bye.
Thank you for being here on the show. Please remember to subscribe and hit the notification bell to get notified when there are more shows available. And if you would like to have more information on how to start investing in real estate, please visit my website at www.aracelihernandez.com. Thank you.